Denison Mines is trading right now at $2.92, down a sharp $0.17, or about 5.50% on the day. Now, the immediate expectation for anyone watching the uranium sector is that this is just noise. The uranium thesis is strong, nuclear energy is back, and Denison is a key player. So a 5.5% drop is just a pullback, a buying opportunity before the next leg up. But the reality of what's happening today is a much clearer and frankly harsher reminder of what this company actually is. This 5.5% slide isn't just random market static, it's the market directly reflecting a slight pullback in the uranium spot price and processing the immense risk embedded in this stock. Denison doesn't sell uranium, it hopes to sell uranium. This means its stock price acts as a highly leveraged, high-beta instrument tied directly to the minute-by-minute speculation on U308 prices. Today, that speculation is negative, and Denison is paying the price. This isn't like Apple stock, where you can look at iPhone sales. This is a pure bet on a future commodity price, and even more so, on this specific company's ability to execute a very difficult plan. Let's establish the common ground, the narrative that has pulled so many investors into this name, whether they're using Fidelity investments for a long-term hold or trading it on the Robinhood app. The story is admittedly compelling. The world is finally waking up to the fact that to hit decarbonization goals, you need stable, carbon-free baseload power. Wind and solar are great, but they are intermittent. Nuclear is the only proven solution that can run 24/7. We see countries that shut down reactors, like Japan and Germany, scrambling to reverse course. We see China building a massive fleet of new reactors. We see the United States government supporting the existing fleet and funding new designs. This creates a structural demand for uranium, the fuel for these reactors. On the supply side, the picture is even tighter. For the last decade, the price was so low that nobody invested in new mines. The market was flooded by secondary supplies and underfeeding. Now, the main producers, Cameco and Kazakhstan's Kazatomprom, are struggling to meet their own production targets. We've had a coup in Niger, a major supplier. And there's the massive geopolitical question mark over Russia, which controls a huge portion of the world's uranium enrichment and conversion capacity. This supply-demand deficit is real, and the consensus is that the uranium spot price must go higher to incentivize new production. This is the expectation. This is the narrative that makes perfect sense. And right in the middle of this perfect story sits Denison Mines, holding the keys to the Wheeler River project in Canada's Athabasca Basin, the single highest-grade uranium district on the planet. The expectation is that Denison is the next Cameco, a future producer set to make a fortune selling high-margin pounds into a starving market. But here is the reality that this 5.5% drop forces us to confront. Denison is not a miner. It is a development stage company, and its entire valuation is a hypothesis. It's a complex financial model sitting in an analyst's spreadsheet, not a producing asset. The Wheeler River project is incredible on paper. It's 95.7% owned by Denison and contains two main deposits, Phoenix and Griffin. The real prize is Phoenix. It's slated for in-situ recovery, or ISR mining. This is where the company's feasibility study gets so exciting. It projects an operating cost of just $4.57 per pound. When the spot price is north of $80 or $90, an operating cost under $5 isn't just profitable, it's a license to print currency. This is why investors are so excited. This is why SoFi investing forums are full of rocket emojis next to the DNN ticker. The reality, however, is that ISR has never been commercially deployed in the unique, complex, high-grade basement rock of the Athabasca Basin. It's a proven method in the sandstone deposits of Wyoming or Kazakhstan, but Phoenix is a different geological beast. The expectation is that they'll just flip a switch. The reality is that this is a massive, multi-year, technically challenging undertaking. They have to prove they can inject their solution, dissolve the uranium, pull it back out, the recovery part, without it leaking into the environment, and do it all economically at scale. The company is doing extensive testing, and the results have been promising, but a successful field test is not a full-scale commercial mine. This technical risk is enormous. Furthermore, this is Canada. The permitting process is exceptionally rigorous, involving federal and provincial governments and, critically, First Nations stakeholders. A single delay in permitting, a single objection, can push the timeline back by years. And in a valuation model based on discounted cash flows, pushing production from 2028 to 2030 can have a devastating impact on the present-day stock price. This is why the recent stock movement is so important to understand. When you see a stock like Nvidia stock move 5%, it's almost always tied to an earnings report, a new product announcement, or a major shift in AI demand. When Tesla stock moves, it's about delivery numbers, price cuts, or Elon Musk. When Denison moves 5.5% on a random Tuesday, it's often linked to nothing more than a 1 or 2% move in the spot uranium price, amplified by the leverage of its non-producing status. The stock also gets pushed around by flows in and out of uranium ETFs, like the Sprott Physical Uranium Trust. When that trust is actively buying pounds in the spot market, it creates a feeling of scarcity, and all the developer stocks, including Denison, catch a bid. But when those flows reverse, or even just pause, the momentum traders, using their interactive brokers platform, head for the exit. This isn't investment in the traditional sense, it's high-stakes speculation. Many retail investors, especially those new to online investing, see the uranium story and just buy the cheapest stocks. They look at their Fidelity cash management account, see they have a few $100s, and buy fractional shares of DNN because it's cheaper than Cameco. They might not realize they are buying two fundamentally different things. Cameco is a profitable, producing miner with long-term contracts. Denison is a development play. It's the difference between buying Fidelity brokerage shares of a company that owns a skyscraper and buying the blueprints for a skyscraper that hasn't been permitted yet. Both have value, but their risk profiles are worlds apart. This is where getting investment help or using a more managed approach like Schwab Intelligent Portfolios might be suitable for most, as those systems would likely allocate only a tiny fraction of a portfolio to something this speculative. This is self-investing at its most acute. So what exactly is the business of Denison Mines right now? Their balance sheet shows cash, and their income statement shows, well, not much from mining. Their revenue comes from their 22.5% ownership of the McLean Lake Mill, which is a key processing facility in the Athabasca Basin. Right now, it's processing ore from Cameco's Cigar Lake mine, which generates steady, reliable cash flow for Denison. This is critical. This side business helps fund their overhead and development costs at Wheeler River. They also have a strategic portfolio of physical uranium, which they can sell if needed. But make no mistake, 95% of the $2.92 stock price is tied to the market's belief in the future of Wheeler River. The company's job, therefore, is not to sell uranium. It's to sell the story of Wheeler River, to de-risk the project step by step, to hit permitting milestones, and to keep the market believing in that 2028-2030 production timeline. This brings us to the future outlook, and the tension between expectation and reality becomes everything. The bullish expectation is straightforward. The uranium supply deficit worsens. Utilities panic and rush to sign long-term contracts at prices well over $100 a pound. Denison successfully navigates the final permitting hurdles. They secure financing to build the Phoenix ISR facility, perhaps with a partner or a favorable government loan. They begin production, and those 4.57 per pound costs turn out to be accurate. In this scenario, Denison's cash flow will be astronomical, and the stock price, well, $2.92 will look like an absurdly cheap entry point. This is the dream everyone holding the bag is counting on. Now, the reality of the risks. First, the technical execution. What if the ISR field tests don't scale up? What if the geology is more complex than modeled? What if they can only recover 70% of what they planned? The project's economics would be severely damaged. Second,